Hey guys, what's up? It's your boy E White coming back again. I just want to go over understanding the market dynamics of what we call sentiment trading. Okay, so today we're just going to learn how to understand what we call supply and demand in the market. And this actually will help you basically and virtually anything if you want to do business as well too. All right, so if you're not familiar with some of the terminology, if you see short and you see long on here, short means that the traders believe that an asset is going to drop in value, okay? And long means that the traders believe that the asset will grow, all right? So you heard the terms bulls, bears. So this short is the bears, and the longs are the bulls. All right. So in any market, it's a combination of a tug of war between bulls and bears to see who can have the dominant, hand on trending markets. Okay. So now here's the thing: when it comes to understanding this, when you see 70%, a lot of times people think that majority rules. Not necessarily, especially in certain industries. In the trading world, the majority does not rule. It's the minority that rules, and the minority are the ones who build wealth over time, and not the majority. The majority actually funds the minority, okay? So we're gonna look at this situation right here. You got 70% that believe that whatever asset, so let's say the asset name is ABC. They believe that ABC is overextended, it needs to drop in price, and so traders doesn't feel that the asset has any more juice to go, right? So 70% are getting their orders ready to say, hey, it's gonna drop, we're gonna make money on the drop, or maybe they're just looking to sell and they wanna buy back at a lower level. But what happens is, you have to ask yourself the question. So we have what we call supply zones and demand zones. So your supply zone is normally at the top, or always at the top. So you got supply zone, and then at the bottom, you have a demand zone. So supply zone is where all selling happens. So basically, selling, and the demand is buying. All right, so we got that out the way. So the question is going to be, if 70% are right, how do they get paid? And that's the fundamental question a lot of people don't like to ask. Well, who's going to pay them? So let's just play the lottery game. I got close to 4,000 something or 4,000 plus friends on Facebook. So out of my 4,000 friends, if 70% of that, so let's see how much 70% of that is of 4,000. I think I got a little bit more than that, but I'm just keeping it simple. All right, we're gonna do 70%. All right, so that's gonna be 2,800 of my friends. All right, if 70% of us won the lottery, but we all put in, all 4,000 put in, there's not that, you see what I'm saying? It's an imbalance. So how are we really gonna get compensated? Yeah, we won, but we're really not gonna really feel the winnings is because too many people won. You know what I'm saying? So that's too many people who got to be paid out. And so the more people get paid out, the more you take away from what you could have had it been a limited amount of people. You look at TV shows or movies when they have a heist, when they're trying to break into a bank. They start out with a large team, but then over time, the team gets smaller and smaller because greed kicks in, right? People start turning their back on people because they want to reduce the number of people so they can have more in the end, right? Don't do that. You get what I'm saying? I'm a man's man. I'm gonna honor my word, but you get what I'm saying, right? So that's greed, and that's a good way you can look at it. Okay, so the market is like a grand heist. To be honest, they use you, the majority, to gain the positions that they want, and then when it's time to collect, they turn their back on you. And that is probably one of the best examples that I can actually give you about that. So let's go back over to this, and you'll notice that if 70% actually wins, how do they get funded? Well, they can't. So what happens is the market continues to go up. Let me use this instead. Market goes up. Why is the market going up? It's because 70%, let me move this down for you. 70% have something going on above them as well too. The 70% has to protect themselves. So 70% have what we call stop losses up here. Okay? Their stop losses becomes another zone. Okay? Now, if 70% have their stop losses here, let's say that's worth $3 billion. Okay? And then your longs, let's do this. All right, your longs, they got stop loss too. So your 30% that's long, they have stop losses too. But if their stop loss is only 1 billion, the market sees that as an opportunity. The market is not going to collect 1 billion to pay out 3 billion. You know why? It's because remember the 70% says it's going to go short. So if the 70% win, that means you got to split $1 billion with 70% of the people. So it's really not worth it, right? So the market says, wow, look at all this up here. So how about we just take the market here, collect, and then now out of the 3 billion, we pay the 30%. The market would rather pay 30% out of $3 billion than 70% out of 1 billion. So the market goes here, and then when the market gets here, if you're shorting a stock, that means you got to buy it back. So what happens is you add more pain to it. So the market gets pushed even higher. It's because whoever was shorting over here, they got to buy back their position at a higher price. So it keeps pushing it up. So a lot of times when y'all see a stock that's keep going, like for instance, the S&P 500 just broke another record going to the upside. A lot of y'all think that's organic. It's not. That means there was a lot of people in the market that was short in the S&P 500 and it went against them. And now they have to go back and buy those indexes or ETFs. So that's why it's going up. So it's what we call a short squeeze. So it's a lot of dynamics to go along. I just want to give y'all that so you can understand. So basically, don't follow the crowd, all right? Observe the crowd. They give you the answers. Okay, I use this all the time, especially in my Forex trading. And we can use it in the futures trading in the crypto market as well, and for the stock market. We can gauge and see how many orders are in one direction. And then we look at the charts and we analyze and we can see opportunities where there would be some accumulation, distribution, sell-offs or whatnot. So I hope that help you guys. Ask questions, leave anything in the comment. Y'all have a great day, all right?